First off, let me bring in Rucha Somaiya as well, who's joining us on this show. And with us, we have Mr. Ashish Rai, who's the CEO at Aurionpro Solutions, to talk to us about the Q2 numbers. Mr. Rai, just talk to us about margins, because EBITDA not growing in line with top line. Give us perspective on what's happening.
Yeah, so look, I think my guidance of this while Hersh has been will have revenue growth between 30 and 35, EBITDA between 20 and 22, PAT between 15 and 16. I think EBITDA is between 20 and 22, came down a point. PAT is slightly above 16, so slightly above guidance. I think it not sort of emphasize too much from one quarter to the next. The reason we give a wide band is the numbers will keep on moving at the pace at which we are growing, the pace at which we are investing in the product, the pace at which we are expanding the markets. It's very hard to calibrate that fine point. I know people look at it. This specific quarter, I think we had a forex loss, which basically cost about a point on the EBITDA in one of the subsidiaries, about 4 odd crores. So that does move the number a bit, but by and large, I would not read much into a movement. It's a solid quarter. The revenue continues to grow, and we continue to deliver.
Right. Thanks for that, Mr. Rai. This is Rucha Somaiya joining in. Can you tell us more about the margin walk? I can see that the change in inventories is what has hit the margin. Also, employee benefit expenses are a tad higher as a percentage of revenue than the last quarter. So how do you expect this to move in the second half of FY25?
Yeah, that's a very, very good question, Rucha. Thanks for that. So look, I think for us right now, the main focus of the enterprise is how do we capitalize on the demand environment in front of us. The demand environment has been really very, very strong. The question is how do you capitalize on it, and which means we will continue to put some product build outs ahead of revenue. So the way the product business usually operates is you need to invest a fair amount of capital upfront to get ready if you're getting into new markets. So our core product build outs are by and large done, but there is a lot of incremental build around making the stack AI enabled or AI native, depending on what the strategy is, as well as getting market ready where we are succeeding. So we expand into Middle East, we expand into Southeast Asia, and there's a lot of market readiness to be done. So that sort of points to the R&D spend, which we expense out, and that is where the employee spend has been increasing. So you'll always have to keep investing a little bit ahead of revenue. So I think that's where the sort of movement has come in, right? I think we are not very intensive as an organization, but we do need to build up scale. We're now at 2,500 plus. We expanded the R&D setup quite significantly over the last, I would say, 3 quarters, and that will climb up a bit. But then, the revenue will also keep climbing up. So, by and large, that's the picture.
Got it. So, Ashish, a couple of quick ones on margins before I close that out. So, 20 to 22%, is that the band we can expect margins to be in? Because you've consistently been there. Couple of quarters, 23, but otherwise, 20 to 22% is largely the band we can expect you to be in?
Yeah, so Hersh, and probably I'll spend just a bit that comes in, right? So we will stick to that band. And we found that to be the right band, because when you're growing at 30, 35%, parts of the business are growing at 3%, it's hard to calibrate margin down to a very fine point. The second is the philosophy of the organization, right? So unlike a services setup where revenue is just a function of people, the products and platforms business that we are in, we do need to invest a lot of capital to build the product out. We expense this R&D that is right now running at slightly above 9% of the top line, right? And that the commitment we have to the investors, or rather the guidance that we have, is we'll keep EBITDAs between 20 and 22. As the products scale up, obviously operating leverage comes in and the margins improve. We'll pour this excess back into the R&D spend, because right now, at least for the next 3-4 years, the focus still is getting new products out, capitalize on the demand in front of us. We'll probably have very, very strong demand the next 5-7 years. So this is the time to step up these and not really try to increase the EBITDAs too much. But between 20 and 22, we feel confident about keeping it for quite some time.
Ashish, I believe there's a problem with bandwidth. I'm going to quickly have someone check on that. And maybe take a minute or two to do that. But while we are at it, I'm just going to quickly look at Aurionpro's numbers. they're guiding for a 30+% growth, Rucha. This is a company which is trading at trailing 12 months 55 times in terms of earnings, with a 30% kind of growth trajectory, committing to a 20 to 22% kind of band where margins will be at.
Right.
So valuations will likely, maybe 2 years forward, start to look much better than what they currently are at. But just talk to us about product suite. What is Aurionpro doing in terms of expanding product suite? He's talking about R&D.
Right.
I'm curious to know.
Right. So Hersh, basically overall this company has two verticals. Number one is the sale of software services, which contributes around 68% of the company's revenue. And the next part of it is the sale of equipment and product license, which contributes the balance around 30% of the total revenue. Now the focus of the company is to expand the software services, and this time the margin in this vertical has come down a tad at 79% versus 84% same time last year, whereas sale of equipment and products license, which contributes a lower share of the revenue, has actually expanded in margin. It came in at 37% versus 32% last year. But we'll see what Mr. Rai has to talk to us about this one. But Hersh, if we look at the stock price performance, I mean, the company has really done well. It has given 125% returns over the last 1 year. Now, you talk to us about the valuation of the company. Do you think an investor should get into this, or what are your thoughts on this one?
Yeah, so I mean, of course, we'll have to understand from Mr. Rai as to how long can this 30% kind of growth run rate continue. Trailing 12 months, they're doing around 1,000 crore of revenue, around 215 odd crore of EBITDA, which is roughly at 21.5%. If they grow at 30%, this will likely also continue to grow at roughly 30 to 40%. It's a roughly 10,000 crore in market cap. It's trading at roughly 4 to 5 times EBITDA current, and likely that will, 40 to 50 times EBITDA current and 55 times earnings trailing 12 months. That's how I'd break it up. I'm not sure if we have Mr. Rai back. Stock is obviously down 5%. Okay, Ashish, if I can ask you, you've guided for a 30% growth in FY25. What I want to know is, demand traction is strong. How long can you grow at 30% for?
Yeah, so Harsh, for quite some time, we think, we pivoted away from what was a fairly diversified IT services style model 4 years back into building out a global products and platforms player that can really play on the global stage, right? The dream was to build out a really mature enterprise technology business rooted in India. So we selected a few segments where we will operate. These segments, we were confident, have a demand runway going 5, 7, 10 years out, because there is something fundamentally transformative happening in those spaces, right? And that's why we feel so strongly about the demand environment, whether it's transformation on the corporate banking side, which is 55% of our revenues. We've got very mature products in lending, in transaction banking, where we see the banks continue to move away from their custom software builds into a mature global product. Whether it's transit payments, again, very strong demand, because we feel over the next 5, 7 years, the entire world will move away from closed loop payments to open loop payments, where we have a cutting edge stack, very successful in US, very successful in Central America, now moving into Europe, right? So each of these spaces, data center space in India, again, unprecedented demand. Enterprise AI, we feel, is a very, very large opportunity over the long run. So we selected these spaces because we knew there is something fundamentally transformative happening in that space, which creates that demand. So I think for the next 5, 7 years out, we do see a very strong demand runway ahead. We painted a vision 20, 30, 4 years back for ourselves. We want to be a top 3 global player in each of these spaces. We're still a fairly small player. These are all double-digit billion-dollar spaces. So we feel very, very good. We have to focus on the product. We have to focus on the technology, make sure we build out tier 1 products that can compete globally. I don't think demand is an issue.
Okay. So demand is not an issue and AI is another next opportunity for you. But let me talk to you about the segment and highlights quickly. Well, the sale of software services where, 68% of your revenue comes in, dropped down a little bit in terms of margin, whereas the 30% of the side, that is the product license side, actually improved in terms of margin. So what kind of segmental mix do you see going ahead in second half, number one? And number two is, what kind of new product launches are you looking forward to in the second half of FY25?
Okay, yeah. So Rucha, I think I would not read too much into the services versus licensing revenue from one quarter to the next, because most of the services that we do are also around the products that we sell. Right. So I think it's a question of revenue classification, but because the order book is very, very strong, because we won a number of new deals, when we win the deals, licensing revenue is a little bit more, and then the implementation revenues kick in, and then the support revenues kick in after that, right? So I think the mix will change from one quarter to the next. I do not think that makes a lot of difference from a margin profile standpoint. Of course, the steady state AMC revenues are very high margin, and while you're enabling the customer, you're low, but it sort of evens out over a period of time, right? So I think, sorry, I missed your second question, Rucha. Can you ask that again?
Yeah. What kind of new products are you looking forward to?
Yeah. So look, I think for us, the single biggest investment we are making right now is enterprise AI. Right. So we feel, of course, there's a lot of sound bites around frontier models and LLMs and all, and we'll see where that game goes. But we feel as any technology matures, a bulk of the value creation happens on the application layer, and hence bulk of the value capture for vendors like us happens there. We are already a very mature enterprise application house, right? We did an acquisition for Arya.ai, which is probably one of the strongest enterprise AI teams exclusively focused on banking and financial services world, doing it for 10 years. Right? We are bringing together our enterprise application stack together with the ML capabilities, AI capabilities that Arya.ai brings into very, very mature offerings. A lot of the wins that we've announced recently over the last 3 months actually have been on stacks which have been AI enabled, right? So transaction banking, for example, we're bringing in more and more use cases around, right? So ultimately, I think a lot of where the banks use technology, right? I mean, they're using our applications, mission critical applications to run their business processes. That is where the value gets created, and that is where we are making a lot of investments around new product launches. The entire Aurionpro stack will be AI native pretty much in terms of the application stack going out.
Right. Right, Ashish. Pleasure chatting. Of course, larger chat warranted. Very interesting space. We look out for this one, of course. But good luck for Q3 and beyond.
Thank you, Hersh. Thank you.
Right. But let's immediately cut across. We have Kunal Bell.